Imagine a global financial system on the brink. In 2007, as losses from mortgage-related assets began to ripple through markets worldwide, the stage was set for one of history's most impactful economic downturns. Today, we explore how risky lending practices and regulatory failures led to the Great Recession. The financial crisis of 2008, also known as the Global Financial Crisis or GFC, centered in the U.S. and was triggered by a collapse in the housing market. Let's start with understanding why this happened. At its heart were risky lending practices where banks issued mortgages to individuals who couldn't afford them, called subprime loans. These loans, bundled into mortgage-backed securities, led to significant financial instability. Financial institutions took on excessive risk, believing in an endless rise of housing prices and complex derivatives that masked the underlying risks. This created a bubble that burst under pressure. In December 2007, as losses mounted and financial firms faced distress, the U.S. economy officially entered recession. This wasn't just a domestic issue, it had global implications. The crisis highlighted the need for stricter regulatory oversight and marked a shift in economic policies worldwide. It's a stark reminder of how interconnected our financial systems are. In summary, the 2008 crisis was driven by risky lending and complex derivatives that created a housing bubble. Its impact was global, leading to stricter regulations and economic reforms worldwide. What aspect of the financial crisis do you find most surprising? How do you think we can prevent such a crisis in the future? Share your thoughts.